More on Thursday's sell-off in China's stock market. We are joined by Anthony Chan, who's the Managing Director and Chief Economist at JP Chase. Anthony, really rough day in the Chinese markets today, drop of 6.5%. But if we take a look at the Chinese stock market, really it's been on fire over the past year, more than doubling its value. Why has it been so hot? What's been driving the market?
I think what's driving the market here is the expectation that the central bank will, in fact, move aggressively to stabilize the economy. The central government accelerating some of the infrastructure projects. In short, that economic growth will get re-energized again, and that's one of the reasons why the equity market is doing so well.
And who's been really fueling the market? Who are the investors that are the big players right now? Is it institutional or is it the retail investor?
Well, I think you have some institution, but you got retail investors that are getting very excited about the market, and it just because the equity market is much. And that this first month this year is up more than 40%. It's very hard to find other equity markets that have performed that well.
Now, of course, speaking of investors, Jim Rogers, a very famous investor, has purchased more of China's A shares last week. So those are shares that are denominated in renminbi. What's the general attitude right now of global investors when it comes to China's A shares?
I think that global investors are getting very, very excited. There is some talk that you're going to include the A shares and the MSCI indices and maybe even the FTSE. That will bring a surge of foreign money into the equity market, especially the A shares. And that's one of the reasons why some people are very excited and trying to front run that surge of money that's likely to come as these equity market indices become more mainstream.
Okay, but at the same time, a lot of excitement about the Chinese market, but we're seeing that regulators seem to want to control a little bit by implementing tougher margin lending practices. And we're also seeing that the brokerages are doing the same thing. Why do they need to sort of put the brakes on having investors invest on margin?
Well, that's actually a very healthy development. That actually makes me feel more encouraged about this rally, because what you've seen in margin lending, it's more than quadrupled in the last year. And so if you were to extrapolate that trend over the next 12 or 24 months, if it continues, that's the point where you start to worry about whether or not you reach that euphoric or bubble-like condition. So I think if they sort of slow it down and we see that the equity market doesn't have to go up more than 100% every 12 months, because if it continues to do that, that would certainly be unsustainable. So I think it's very healthy that regulators and brokerages are now moving in the direction of at least trying to temper some of this excitement.
Right. So regulators tried to do that in January, and we saw the market sell off also, roughly about 6%. Do you expect the sell-off to continue, or is this a one-day loss?
No, I don't think it's just necessarily a one-day loss, but you're going to see these rolling corrections. And by the way, these corrections are very healthy, because these corrections give investors an opportunity to come back. It gives an opportunity to reprice those shares that maybe were too expensive, but nonetheless the fundamentals are improving. So I think that these corrections are healthy. And so over the next 12 months, I expect more corrections, but I think in the next 12 months, I also expect the equity market, especially the A shares, to be higher.
Okay, so you seem to think or be bullish still on the Chinese market, but at the same time, we're seeing that in the first quarter of this year, growth slowed to about 7%. The market's still marching higher. Some people are saying that this is a case of irrational exuberance. You don't seem to agree.
I don't think it's irrational exuberance yet, because if you look at forward earnings, they're still fairly competitive with, say, the U.S. S&P 500. And if you look at the Shanghai equity market today, it's still almost 20% below the peak in 2007. And so when you say that the economy is slowing down to 7%, keep in mind that China is now the second largest economy in the world. It's unsustainable for it to continue to grow at very high rates. And in fact, the People's Bank of China recently put out a report that they expect that that number is going to continue to come down. But as you come off a bigger and bigger base, it's still impressive to grow at 7% or even 6.5%.
Right, we all want that right now.
That's
here in the
right.
U.S., definitely. But talk about the tech sector, because there are some that are saying that we could be in bubble territory as Chinex, which is sort of the NASDAQ of China, is trading at 130 times earnings, which is very high. You don't think there's a bubble in that sector?
Well, price-earnings ratios are good because they tell you something about earnings relative to price. But to the extent that we're going to see a surge or, in fact, an acceleration of economic growth relative to where we are now over the next couple of years, we will see those earnings starting to pick up. And these price-earnings ratio that seemed a little bit high right now won't seem as high as those earnings start to come in. These stocks maybe have not seen as many or as much of the earnings that we would like to see, but to the extent that they're going to be a lot of restructuring and the economy gets re-energized, you will see these PE ratios coming down.
All right, I want to be contrarian a little bit for the last question here, because there are some who do believe that there is a bubble occurring there in the stock market. If, in fact, there was a crash in China, how would it impact the economy there?
Well, I think it's never a positive development. But
would it be catastrophic like it was
is not
here?
catastrophic. I mean, if you look at retail investors that are big players in the equity market and have benefited from this surge, if you look at their share of wealth, it is less than 10% what they have in housing. So it's not a huge amount.
Okay, thank you so much for your thoughts.
Thank you.
Great.